Simply put, an E-2 visa business valuation is the calculation of the value of the business that's being acquired by the applicant. An E-2 business valuation is important because it justifies to USCIS or the consulate that the investment amount that the applicant has put at risk is at least 51% of the acquired company. E-2 valuations are pretty much exclusively for immigrants that are looking to avail the E-2 visa by acquiring the majority shares of a business. It would apply to those applicants whether they are currently in the U.S. or outside of the U.S. It also primarily applies to applicants acquiring less than 100% of the target company. The optimal time to get the E-2 valuation completed is prior to the submission of the E-2 visa application. By having the E-2 valuation completed, it allows the applicant and their attorney to submit the valuation as a part of the total application package. Doing it this way will save time by preventing in advance the potential for an RFE letter from USCIS or additional scrutiny asked directly in the consulate interview based on the valuation of the business that's being acquired. Now, let's say, for example, the E-2 valuation is not submitted as a part of the total application package, and then USCIS comes back with an RFE or the applicant is asked in the consulate interview for proof of the business valuation. This will delay the process because now the E-2 valuation will have to be constructed and completed and then submitted to USCIS or the consulate for their eventual evaluation and approval. An E-2 valuation should be comprised of a PDF of the valuation report that clearly shows several years of historical financials as well as all of the calculations of the various valuation approaches used to conduct the valuation of the business. A minimum of 2 valuation approaches should be used when putting together an E-2 valuation. Depending on the profile of the business that's being acquired, Journey will look to use a minimum of 2 approaches by choosing from the discounted cash flow approach, or DCF, the industry multiple approach, and asset-based valuation approach. A good valuation supports the E-2 visa application because it will show to USCIS or the consulate that the investment amount put at risk by the applicant is at least 51% of the total value of the business that's being acquired. And that is a critical qualifying point for an applicant to be approved. Financial due diligence is a thorough investigation into a company's financial health. It involves examining the financial statements, the income statement, the balance sheet, and the cash flow statement to ensure the accuracy and sustainability of the numbers. This process helps identify any hidden liabilities or risks that might affect the company's financial health. Financial due diligence is a crucial step to undertake when seeking to acquire or invest in a business for several reasons. It helps mitigate financial risks such as undisclosed liabilities or irregularities, which could impact the future performance of the business. It helps ensure that the financial information presented by the target company is accurate and complete, providing a clear picture of its financial reality. And it offers valuable insights into the company's financial performance, position, and prospects, which are essential for strategic planning and future growth. Financial due diligence is for an E-2 applicant and, for that matter, really anyone who's looking to acquire or invest in a business that wants to know the true financial picture of the target company before going forward with the transaction. The components that comprise financial due diligence are income statement analysis, balance sheet analysis, cash flow analysis, ratio analysis inclusive of activity ratios, liquidity and solvency ratios, and profitability ratios. Finally, a due diligence scorecard where we analyze, of course, the overall financial performance, the prospects for the future, marketing, human capital, its competitive environment, and any other risks that we see with the business. We then conclude with our summary and recommendations. The documents reviewed to conduct financial due diligence are historical financial statements, tax returns, any projections or financial forecasts that the company has put together, detailed debts and liabilities to fully understand the company's financial obligations, and, if applicable, internal processes and controls that give a view on accurate financial reporting.